Hi there, welcome to Kneppy Invest, and welcome to the question, is Treasury Wine Estates a high quality company? This was a question I have received or did receive from a viewer. So if you do have a question in regards to whether or not a company is high quality or any other type of question that I can answer, leave it in the comment section of this video, because what I'm going to do over the next few months before I go on a 2-month trip is I'm going to bank a lot of videos or pre-record a lot of videos so I can release those videos during that 2-month period. And this is the sort of video I would like to do. So, is Treasury Wine Estates a high quality company? Now, when I ask myself that particular type of question, I usually go down an objective route. I want to have a look at numbers, because numbers don't lie. Now, you can manipulate numbers, but numbers don't lie. Now, a lot of people, a lot of experts like to go down the subjective route. They like to question management, have a look at management, have a look at the moat of a company. And even though moat can be subjective, you can actually determine whether a company has a competitive advantage or has a moat just by looking at gross margins, and whether gross margins are increasing or decreasing can tell you if a moat of a company is being eroded or growing. Now, one of the most powerful types of moats is brand recognition. And fun enough, Treasury Wine Estates does have a bit of brand recognition because they own Penfolds, and Penfolds, high quality wine. I'm not a wine expert, but there is a bit of brand recognition when it comes to this particular company. Now, they do have 3 divisions. Penfolds is one of the divisions. In fact, one of the main reasons I might like this company as a longer term hold is just because of Penfolds, and they might spin Penfolds off. It has been discussed in the past. I'm not sure how serious they would be, but one of the reasons I could consider buying this company for the longer term is just the potential that Penfolds is spun off. They also have Treasury Premium Brands and also Treasury Americas. I believe they made a pretty big acquisition a few years ago, and that's why they have Treasury Americas. I could be a little bit mistaken with that, but I'm pretty sure that is true. So what I'm going to do now is I'll go through via FinChat some of the numbers. Some of the numbers I look at in determining whether a company is high quality or not is revenue growth, earnings per share growth. I have a look at gross margins, also operating margins. Also, I like to look at how gross margins and operating margins are changing through time over the last 10 years. I like to have a look at return on equity, return on invested capital, particularly over the last 5 to 10 years. And thankfully, FinChat does that for you. I don't have a look at valuation. Valuation is not important when determining the quality status of a company. It's not important at all. Valuation is only important when you discover or figure out the quality of a company. And if it's high quality, is it value at these current levels? So if I determine Treasury Wines to be a high quality company, I'll then have a look at the valuation. Now, if I determine Treasury Wine probably not to be high quality, then I'll have and focus more on technical analysis. Is like the trend changing? Is there more positive sentiment coming into the company? But in saying all that, even when it comes to technical analysis, valuation matters. So I'll always come back to valuation, always come back to the chart. Even if a company I would consider high quality, also have a look at the chart. But chart or technical analysis is much less important for high quality companies than lower quality companies. In fact, for a lot of my high quality companies that I own in my super, I rarely look at the charts for those companies. And when I do look, I just move on to the next chart because I don't really care about the charts for those companies. I just care about valuation and whether or not the company is high quality or not. Okay, so I'm rambling on a little bit. So let's get into whether or not Treasury Wines is a high quality company. So this is FinChat. You could use any other sites. I used to use Guru Focus, but they charge a little bit more money. Now, one of the things I liked with Guru Focus is they tend to focus on revenue per share growth. So not only earnings per share growth, but also revenue per share growth. The reason I do prefer revenue per share growth over just revenue growth, it takes away acquisitive companies. So companies can grow their revenue by acquiring and acquiring and acquiring more companies, but they also will dilute mostly, not always. They might increase their debt, but a lot of times you will see shares on issue increasing, and that does affect revenue per share growth. So I do prefer revenue per share growth. Anyway, so also I like to have a look at certain time periods, like 3 years, 5 years, 10 years. I don't really focus on the 1 year because sometimes a company can have a bad year, but you don't want to see 3 bad years in a row. Anyway, so let's have a look. And to be honest with you, the first thing I always have a look at is revenue per share growth or revenue growth. So as soon as I see Treasury Wine's revenue growth, we're talking about 6.2% over the last 3 years, 1.1% over the last 5 years, 5.1% over the last 10 years. Straight away, that is it is a red flag. It's not a massive red flag. It's not negative growth. It is growing. But again, they've made a pretty big acquisition. So I'm wondering whether the amount of shares on issue have increased substantially. Because when I have a look at earnings per share growth, we are seeing negative numbers. And that is a massive red flag. Now, back to revenue growth. I do prefer revenue growth to be above 10%, but I'm willing to take between 5 and 10%. I'm willing to take that, but I want to see above 10%. And the main reason behind that is you have to take into account inflation. Now, if inflation over the last 10 years is 5% per year, it's not. But if it is 5% per year, this company really hasn't grown at all. Now, earnings per share, this is a pretty big red flag. Negative 17% over the last 3 years, negative 20% over the last 5 years, negative 2.9% over the last 10 years. So earnings of this company have gone backwards over the last 10 years. That is a red flag. Now, forecasts are suggesting that earnings per share will grow over the next 2 years. So earnings per share forward, 2 year, 13.8%. Will that happen? Remains TBC. Okay, so we've talked about growth, revenue, and earnings. Few red flags there. A few reasons why I would not equate this company. Well, few reasons why I'd probably put this company at the lower end of the quality spectrum. Definitely not at the higher end. So the next things I'm looking for or looking at are gross and operating margins. Gross margins 47.5%. That's fine. That's actually not that bad. And operating margins 13%. But what are the history of this company? So this is gross margin history. I like this. In fact, gross margins have been increasing over the last 10 years. This is actually a positive thing. This is a green flag. This is really good. So this is a possible sign that, yeah, this company has a little bit of moat, a little bit of a competitive advantage. Maybe there is a bit of brand recognition. Maybe. But anyway, so increasing gross margins over the last 10 years. What about operating margins? Oh, this is a little bit different. I'll get rid of gross margins. Operating margins have fallen over the last 5 years. In fact, fallen from 24% to 13%. So something is happening that has affected operating margins. Maybe they're spending more on stuff like advertising and marketing, simple things like that. You might want to delve a little bit deeper into the reasons why operating margins have fallen over the last 10 years. Now, maybe they have reached the bottom at 10.3% in 2024. Maybe they're starting to rise, and that will be beneficial. And that could lead to the earnings per share rising over the next few years as the analysis are forecasting. And this could also be a reason why earnings per share have dropped significantly over the last 5 years because operating margins have dropped from 24% to 13%. Okay, so that's a slight red flag. I don't mind operating margins dropping because that could be something simple as they've increased advertising. But when you do see gross margins dropping, that would be a bigger red flag in my opinion. Okay, back to the overview. So gross margins rising, operating margins dropping. Now on to return on equity and return on invested capital. So in FinChat, they do have a 5-year average, but even though there's a 5-year average, this could be negatively affected by one bad year. So 5.9% return on equity, 5.6% for return on invested capital. So let's have a look at the history. The last 10 years, it's in the capital efficiency. In fact, I call these two metrics quality metrics. In fact, if I had to look at just one metric in terms of quality of a company, it would be return on invested capital, then return on equity. Return on invested capital is not as easily calculated as return on equity. Return on equity is really easily calculated because all you need is earnings and equity, which is right there on the balance sheet. Okay, so let's have a look at the history of both of these. And unfortunately, red flag galore. Now, back in 2018-19, return on equity was above 10%, just above 10%. Return on invested capital was not. Now, I thought maybe there was 1 year where return equity and return on invested capital were highly negative, which did decrease the 5-year average, but this is red flag. So low return equity, low return invested capital. I prefer both of these to be above 10%. In fact, I prefer both of these to be above 15%. I will take above 10%. But when you see low return equity and return invested capital, that is actually a fairly big red flag for me, and definitely an argument to putting Treasury wines towards the lower end of the quality spectrum. Now, you notice I don't look at dividends at all. Don't look at dividends. That's not, it does not matter. But I always have a quick peek. Dividend yield 3.7%. Payout ratio 207.3%. Okay, so payout ratio 207.3% might be a red flag, but that is also suggesting that their profit or earnings in the past year were suppressed by a possible one-off. So let's have a look. It also could suggest why there's been a significant decrease in earnings per share over the last 3, 5, and 10 years. So let's have a look at income or profit. And I should have done this when I looked at revenue and earnings per share growth. It's okay. So revenue growth. This is not that bad. Revenue growing over time. It can be lumpy at times. Maybe not lumpy, but it can pull back at times. But it has been growing. In fact, it has been growing at 4.75% over the last 10 years. But let's have a look at income. And it would not be a shock to see a bit of a one-off in the last year. Yeah. Okay, there was. Profit was down to 98.9 million in 2024. You can see it's been as high as 408 million in 2019, and roughly between about 250 and 300 million between 2020 and 2023. I would expect profit to get back up to those levels, possibly even higher. So what I'm going to do is just assume profit gets back up to, say, $300 million. In fact, what you might even do is have a look at the semi-annual numbers. And there was a loss in the second half of 2024. And in the first half of this year, they had a profit of 220 million. So let's just assume, for calculation's sake, that the profit is going to be 300 million for this financial year. So that means with a markup of 6.5 million, profit of 300 million, that would be implying a P ratio of about 20. So just above 20. So that's still a little bit too higher than what I would like. For me, I'd like to see profit get with a markup of 6.58 billion. Haven't even talked about the debt, by the way. A debt to equity is 0.5. They do have a little bit of debt, but if you're just talking about P ratio, for me to be more interested in this company, I'd like to see the P ratio get to below 15 with a bit of margin of safety, which would mean this company would need to have a profit of around about 450 million. So can they do that? I think they could eventually maybe do that. We've seen a higher profit of $400 million in 2019. So it's not out of the realms of possibility, but I'll need to see that happen. Now onto the chart for Treasury One. So I don't see any compelling valuation right now. So now onto the chart. And sometimes you can tell, by the way, don't think I've definitively told you, sort of implied it. I don't think Treasury Wines is a high quality company just by what I've seen in these numbers. Now onto the chart, and you can actually just have a look at the chart to determine whether a company is high quality or not. So for instance, yeah, this is straight away not a high quality company. Now, if you go back to this period, you could have said, this is a high quality company. Look at the chart. Beautiful uptrend between 2015 and 2018. That was a beautiful uptrend. And I'd say the financial numbers were probably aligning themselves with that sort of argument. But since then, over the last 7 or 8 years, share price has done nothing. This is not the quality. This is not the chart of a high quality company. Share price reached its high back in 2018. So we're talking about 7 years ago. Share price has reached its high. So there are some shareholders who are still underwater when it comes to this company. Now, let's have a look what's happening now. Okay, a few things here. So I don't see any compelling valuation argument with Treasury Wines just now, unless we do see that confirmation of some really big increase in profit. But chart-wise, share price is at a really intriguing level. This could be just, and the reason I say that is we go back to COVID-19, share price fell to a low of $8.30. Share price then fell to a low of $7.80 in late 2020. Remember, that was that Chinese wine tariff on Australian wine, something like that. And I think that was negative. That was extreme negative sentiment when it came to this company. And during that period, the share price fell to a low of $7.80. Yep, $7.80. And right now, in the past week, the share price of Treasury wines fell to a low of $7.98. So very close to those lows. And not only that, on Friday, on really big volume, share price bounced up 4.07%. Look at that volume. Now, there could be a reason behind that. Let's have a look. I'm just going to have a quick look at Treasury wines. Could be some options or something happening. I have no idea. I've noticed there were a few companies that had really big volume on Friday, and there is a reason behind that. Some sort of options, or I forget. But anyway, so I could just chat GBT it, but don't really feel like it. If we just have a look at the course of sales, I just want to see if there's any big trades. Yes, so we saw some really big trades after closing. Look at that. So there is some reason behind that. So that's probably why we saw a really big spike in volume. Look at that, massive trades. We're talking about 8 million shares traded, $68 million worth. And this was all after closing. So that's why this company had really big volume, I think, or one of the reasons anyway. Anyway, so that's a good sign, maybe a good sign. The bottom is close to being reached, but and the other reason is the share price is at a support level. So technically, there is a chance the share price of this company might bounce. There could be some good value at these levels, even though I said just by looking at the numbers, maybe not. But the market might be thinking differently at these levels. Okay, that's all I have for a look at Treasury Wines. Is Treasury Wines Estates a high quality company? I think for me, no. I like to see some better numbers. I like to see some more consistent growth in revenue. I'm willing to say earnings per share decreasing in the last 5 years. This is because there was a one-off in the past year. I like to see higher return on equity, return on invested capital. Gross margins, nice increase in gross margins. I like to see operating margins starting to turn up. That could be really beneficial for the company over the next few years. And you might see some really good growth in the company. And I think there's a chance, if all things go right, the company could see their profit get above 400 million, 500 million. And if that happens, yeah, there is some value in this company at these levels. Okay, so that's all I have for the video. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.